Hello, viewers, and good evening. Welcome again to Time with your Banker and Financial Advisor, sponsored by the Securities and Exchange Commission and Dole Yogurt. Today, we have a very distinguished guest with us. His name is Mr. Paul Ababio, the Deputy Director of Securities and Exchange Commission. Sir, you are welcome.
Thank you. Thank you. And good evening to your listeners as well.
Yeah. Paul, there are a lot of things happening on the financial markets these days.
Yes.
With DKM is passed, now it's men's gold, and some of the banks do have their issues. But you are on the capital market.
Yes.
So we need to educate the public on what goes on exactly on the capital market, because that's where the listings are done, and that's where most of the monies are gathered from to kind of cushion the money market. So, and if people are not well educated in that area, they might end up putting their monies at where they should not. And I think that is what is happening presently because of lack of education. People don't know the directors behind businesses. They don't know what the people are up to. They don't look at their prospectus. People come with lucrative interest rates, then they jump and they give their monies out. But all these monies on the capital market sums up collectively. If we are able to gather them, we can get them as equity for businesses, and that can expand the economy. So this evening, why don't we look at equity and how where businesses can attract funds. At the same time, investors can also invest in good businesses and earn some returns. If we come to the capital market, what exactly is equity?
Thank you for that, Ernest. I think it's a very timely point and a timely discussion to have because equity as a word has various meanings. In common English, it means fairness or impartiality. So we can talk about sort of fair play. There's an actual aspect of law that deals with fairness and justice. Yeah. So that's when we talk about equity. When it comes to finance, equity means the value of shares in a company. Okay. And it represents an interest in an underlying business. So that's what equity refers to. When it comes to the capital markets, the kinds of equity you'll see often are listed shares. That is to say that the shares have been offered to investors through the stock exchange, and the investors are subscribed on it. In the past, if you had shares on the stock exchange, you would have certificates that you still hold. We still have certificates, but they are held by the what we call a centralized securities depository. So investors now have a dematerialized interest in the shares. This is because if you were holding a certificate and tomorrow you want to sell your share, you have to send your certificate to your broker, he has to find a buyer, then he has to send the certificate to the buyer or the buyer's broker, who will then transfer it to the ultimate buyer. So you can imagine how long it will take. And if the following day, the one who bought it wants to sell it, that becomes another process.
Long process.
So those certificates have been dematerialized. And that actually helps because sometimes you do an investment and you're holding a certificate and you don't have a place to keep it safe. So even the keeping of those certificates becomes an issue. So that's what we talk about when it comes to the capital markets. There's another form of equity which we call private equity. So there are firms that offer their shares. They are not public firms or they are not listed on an exchange, but they can get a capital market operator to invest in them. So if you think of what we call a private equity fund or a venture capital fund, it is a fund that has been set up to invest in private companies. Now they do their due diligence, they try to understand the business, they try to understand the corporate governance frameworks around it, then they make an investment in the company. For those investors, their goal is to get out in maybe 3 to 5 years to disinvest their holdings. So that's one form.
But those investors, if the company is not doing well, what do?
Well, that's the point of equity, in that in terms of what we call a capital structure, you have a company's asset. The company has assets, and the assets are funded by liabilities and equities.
Yeah.
Now, liabilities are technically senior to equity. So any cash flows that come into the business ideally should pay the liabilities first before equities are paid.
Yeah.
But because companies are seen as going concerns, when there are cash flows, they might pay some liabilities but also borrow some more. But at the end of the year, what they do is they declare their results. The results are audited. And if there are earnings available for distribution, then they pay the shareholders. If the company is not doing well, then it means there's no more cash flows available for distribution. So the shareholders have to wait.
But we are talking about the venture capital. Don't they jump in to take control of the firm when it's not doing well?
They sometimes would insert certain clauses, which would allow for a range of options depending on the performance of the company. So you are right in that if the value falls below a certain level, or if certain actions occur, they may exercise the right to acquire additional shares. And that will be spelled out in the investment agreement that they would have signed with the target company. So that's one option they have. And I think it's good to have if it's not doing well, but if it also does well,
then I think there's fair play.
Exactly. Even there, sometimes to the limit, because they want to get up to a certain upside. So if it does way better than their expectations, then the founding partner may choose to buy them out. Or they may choose to say that, okay, we've exceeded our target. Now I think the company is ready to go public. So they may go and list the firm on the stock exchange to get their value out. The other shareholders who are not with the private equity firm may choose to stay in the company. So they can buy those shares when they are offloaded on the market. So those are some of the frameworks around it. Yeah.
What are the different kinds of equity? We've talked about venture capital.
Yes. There's one element of equity that is used in the parlance, but it also has implications for an investor, which is if there's a value, a property that has been mortgaged, the equity in that property is the value of the mortgage less the value of the property. So then that is the remainder. Now, a property may have negative equity. So as you say, the company is not doing well, then equity is negative. There's not enough assets to cover that equity. Now, the other kinds of equity, so we talked about common shares, which is what is very popular, but there's also what we call preference shares. Now, preference shares typically pay a fixed distribution, we might say. So maybe the distribution may be set at a point in time when the share is issued, and it might be set as a percentage of the amount issued. So it may be a 5% preference share. So if a share was, let's say, 500 cedis, then the 5% translates into 50 cedis. So there's those kinds of shares. Now, there's a kind of debt that has equity attached to it. It's called a convertible debt. So that debt would typically, because of the equity component, is seen as a sweetener. So normally it should be priced, or the interest on it should be a little bit lower. It's not very common in Ghana, but sometimes the private equity firms might do that. Because if they go in fully with equity, then it means they have to own the whole company. Maybe the firm is valued at 5 million cedis. They are trying to raise another 5 million cedis. That means that the private equity guys have 50% of it. Sometimes they only want to have a minority position. So they might put in, say, 4 million as equity, and then 1 million as a convertible debt.
What's the difference between equity and debt? Because we're discussing equity and you have introduced debt.
Yes.
So let's look at what debt is. Okay.
So debt is an obligation to make payments on funds advanced.
Yeah, like a loan.
Like a loan.
Yeah, so if a company goes in for a loan, it becomes a debt to that company.
Yes.
But if a company gives out a portion of its interest to the public in exchange for funds.
Yes.
That is equity.
Exactly. So the convertible debt is a hybrid. It's between debt and equity. It's we call it convertible debt because primarily it comes as a debt instrument. So it says, I owe you. But upon certain events, let's say it's 5 years, but in year 5, I can convert it into equity. Or if we say that your profits go up to, when we did the investments, your profit was at 1 million. If it goes to 2 million or more, then I can convert it into maybe 1 million shares. Okay, so then that debt, even though you're owing me 1 million, when that event occurs and I choose to convert, then you don't owe me anymore. Now I just own 1 million CDs of shares.
Then I become part of your company.
Exactly.
I'm not your debtor anymore.
Exactly.
I become a
shareholder.
Owner. Yeah.
Now, if you don't want that, then you may have the option to buy me out.
Okay.
All right, so then you take over that instrument.
And then you pay the person off.
And you pay the person off.
That means you've paid off your debt.
Exactly.
Yeah, but let's look at common shares. What are common shares?
So it's a matter of nomenclature, really, because when we talk about shares in Ghana, shares don't have any par value in Ghana. In the past, before the Companies Act was passed, 1963, Act 179.
Yeah.
Shares used to have a par value. Par value being that the share is worth 1 CD. But you can pay additionals. Right. Now what we have is no par value shares. So technically, when you buy a share, you are just paying consideration for your interest. It's not the share as a certificate that you are buying. You are buying an interest in the business. And you pay a consideration for the interest. So in terms of common shares, equity, they are interchangeable and they are used as a similar framework. But in an accounting parlance, common shares refers to the shareholdings, or I might say common equity. So if you look at the balance sheet, on their balance sheet, they'll have liabilities, but then they'll have sort of common shares. Then they'll have retained earnings or income surplus. That is profits that they've made that they are keeping. Now, it is for the shareholders, but it has not been converted into shares. So that is part of what we call shareholders' equity or shareholders' funds, but it is not common shares. So in accounting, we say it's part of shareholders' equity. Okay. And then below that, you may have, if the company had a property that it bought for 1 million cedis, and it values the property, and the value has gone up by another 1 million, that is now 2 million. So your assets have gone up by 2 million. But it is not from its business. It is just from a revaluation. So that 1 million is held on the balance sheet as what we call a revaluation reserve. So they'll keep 1 million there. It is also part of what the shareholders own. If there's a point where they have to distribute the assets of the company, all those assets will be distributed, the retained earnings, but it is not paid for by the shareholders.
Yeah, we'll take a short break here.
Yes. Okay.
Viewers, we'll be back right after this break. This program is sponsored by Securities and Exchange Commission and Dole Yogurt.
Again. I want a mix. Again. I want
Again. We in good shape the whole day. Again. We always want more and more. Again. Dole, tam, savannah. Again. Isusu.
I want to give.
Dole, tam, savannah. We want more.
Welcome back, viewers. This program is sponsored by Securities and Exchange Commission and Dole Yogurt. Yeah, we were on the balance sheet, but let's look at the rights and obligation of a shareholder.
Okay, so typically a company has regulations, and the Companies Act spells out the contents of what a regulation should have. Now, oftentimes, as a shareholder, you have the right to vote at an AGM. You can also nominate board members. Shareholders can also gather other shareholders and call for an emergency general meeting, which is to say that there are specific issues that want to be addressed by the company at this EGM. When they call for this EGM, they have to specify what issues need to be addressed. So shareholders can exercise these rights. At the end of the year, when a company declares its results, it will present it to the shareholders, and will also determine, the company may make a recommendation on the level of dividend to be paid, the remuneration or the compensation for board members, and the selection of the accountants for the following year, the auditors. So shareholders have to approve these things. So they have the right to vote on these issues.
Can they sue a company?
Well, if a company makes misleading disclosures, for instance, shareholders can take on the company in court. If the company or the board tries to usurp the rights of the shareholders, they may take the company on in court as well. So those are some of them. In terms of obligations on a shareholder, sometimes in the unlisted or in the private markets, some shares may not be paid for. Right, so a company may issue shares to somebody. The person gives the company an IOU to say that I'll pay you at some future date. Now, if there's a point where the company is being liquidated, the liquidator will ask for the shareholders to bring capital into the business. So then the liability occurs on the shareholder. And some of these structures are specified in the Companies Act. So that's an obligation. The shareholders also need to request for disclosure, right? Because what the company will put in its annual report really is to a large extent at its discretion. But they may want to understand what are the liabilities. Some companies may issue a guarantee. Those are what we call contingent liabilities. But it can affect the ability of the company to meet its obligations at some future date. Or if those liabilities crystallize and shareholders didn't know, so profits are declared at 1 million, but they have to pay for some guarantee.
And debentures and all that.
And debentures. Then that falls on the shareholders. They'll be affected in terms of the cash flows available to pay them. Or if those cash flows are pledged away, then it's not available for distribution anymore. So shareholders can request for disclosure. They also have to make a determination on the viability of their business. So it is, if you are a shareholder, what it has said is that you have a residual interest in their business. After all the debts are settled, you get whatever is left. So if what is left is not meaningful, then you don't get much.
Yeah, I'm asking this question because I've had a series of calls. People complain that they've invested in certain companies that I don't want to mention on air.
Okay.
And for several years, the dividends have not been paid to them.
Yes.
And it looks as if now their shares are of no value. So they are agitating whether they can sue these companies in court.
There are a couple of guidelines around how a company can pay dividends. And let me talk about the principle of investment first before we get into that particular point. If you think of investing in shares, because you are not getting a fixed payment out of it, you are hoping that the business will perform. If you think of debt doesn't have any upside. If you are owed 1 million, you get 1 million plus the interest of say 100,000. But with equity, if the company does very well, you could get 2 million. If it doesn't do well, you could lose all your 1 million. But in debt, you could also lose, if the company defaults, you could lose the debt obligation. The fact that somebody has made a promise doesn't mean that they can perform against that promise, right? So in
But
the
that
same
one,
way,
the company have assets, so at least you can get some residual.
well, in the case of the banking crisis that happened, the assets of the company were less than the liabilities.
But at least you get something. It's not like the shareholder who doesn't get any, especially the common shareholder.
Yes.
He doesn't get anything at all.
Well, it depends on the liquidation process,
Okay.
and the proceeds that come out of that.
Okay.
So from a shareholder's perspective, you gain from either an increase in the price or the company pays you dividends. Dividends are determined once the company declares its results. Now, if the company has losses, then there's no way it can pay a dividend. However, or there's another restriction actually in the Companies Act, in that where a company has negative shareholders' funds, it cannot pay a dividend. So that is a legal obligation, because from an obligation perspective, they're actually liquidating the business slowly. Imagine a company has losses and has negative equity. Once it pays a dividend, that negative equity becomes even more, and that reduces the ability of the assets to pay for the liabilities. So that's one area for investors to look at. Now,
But
assuming
for
that you are
20 years,
yes,
20 solid years, 15 to 20 years, not paying dividend, and you also not being liquidated, it's not fair to the equity holder,
yes,
the common shareholder, even if it is a preference shares.
yeah. So then the shareholders have to make a decision to sell the shares.
It is of no value now, so you can't sell. If you had purchased that shares at, say, 2 cedis 10, 15 years ago,
Yes.
now you take that share to the market and nobody wants it. And you are also not paid your dividend. So it looks as if you have thrown the baby and the water away. You don't have
Yes.
anything to hold on to.
Yes. Well,
And that's why
yeah.
they are agitating and asking whether they can take such a company to court, sue
Okay.
such a company.
Well, they'll have to consult their
Because-
lawyers.
Because the company is functioning,
still in business.
is still in business.
As shareholders, what they can do, because shareholders can appoint directors. So sometimes you may have a controlling shareholder who is basically calling the shots. In that instance, shareholders may also take an action to request that the company buy back their shares. So in that case, the company also look at its financial position and make a determination. The controlling shareholder may also assume, because the controlling shareholder may have a long-term view, maybe over the past 10 years or 20 years, the company was in development, there were some operational issues, changes in management, and the question becomes that as a shareholder, how do you exit that position? In some situations, there can be a loss. And that is the nature of investment in equity. And I think that's why we're making this point, that you could lose your money. And people have lost money. Even in debt situations, you could lose 100%. In equity as well, you could lose. And that is part of the investment process. In as much as you can make a lot of money out of it, you could also lose your money. When there was a dot-com crisis, the dot-com bubble in 99, there were a lot of internet companies that came up in the US and in the West. And some of those companies didn't have any assets. So even those who lent to it, hoping that they could make money, those who invested in it, lost some money. But out of that, some companies came out whose share prices have gone up by almost 1,000,000%. It has made billionaires out of people.
Yeah.
So in as much as you have the downside of some companies not doing well, you have the upside
also.
of some companies doing very well.
Yeah.
And you can't have one without the other. Right? The potential for that upside is what results in the potential for losses. If there was no potential, assuming you are holding gold, then that is a static asset. The price of gold may go up, but if you don't sell it, you don't get that upside. You are just holding it, right? So that's the dynamic. And even if you take other assets, property, real estate, there could be a flood in your neighborhood, and suddenly the value of property you had that was 100,000 cedis is now 50,000. And there are properties in Ghana, people are trying to sell it, and they can't get the price they wanted.
Can't get the price, yeah.
Because that is not the price of that property anymore. Just that people have a hard time absorbing losses. And that's why we are making a point now that in investment, when you do an investment, whether it is in property, in commodities, in equities, you have the potential for upside. Now, what is the limit of that upside, right? Your 2-bedroom house in Kaswa can't
match a 2-bedroom.
Would it go to 1 million cedis, $1 million at some point? I can't say that.
And it even can match a 2-bedroom in airport or East Lagos.
Exactly.
Yeah.
So you can see that you have a cap, a soft cap. But if you have a share on the stock exchange, your potential loss or your liability is the amount you put in. But your upside,
it's unpredictable.
Exactly.
It could be way higher.
Exactly.
A million times of what you have put in.
Yes.
Yeah, Mr. Ababio, unfortunately, we have to end this show here.
Okay.
But we hope to get you to continue with the series that we've just started.
Okay.
Thank you for coming.
It's been a pleasure. Yeah.
And have a good evening.
You too.
Viewers, this one will end today's episode on Time with Your Banker and Financial Advisor, sponsored by Securities and Exchange Commission and Dole Yogurt. We've been looking at equity, and from our discussions, you've realized that equity are monies that people put into businesses in exchange for holdings in the business, and such holdings comes in the form of shares or bonds, and the companies need to give out monies in return for the funds they have collected from individuals or investors, and it comes in the form of dividend. And when the company is doing well, you get more money. The price of your share or the monies you've put in goes up. But the other side of it is that if the company also is not doing well, you may lose your money. But we need to put all these monies together so we can have a vibrant capital market. If you have money and it's sitting in the house, it doesn't do anything for you. If you put your money in an investment in a form of equity, your money works for you whilst you are at home. Before you do that, you should do a check on the business or the company that you are investing in, so that you don't end up losing your money. We've realized that for the past 2 years, there is a wind or terrain going on in the financial market. We don't want anybody to be caught in that storm. So before you make any investment decision, please seek advice. Please seek advice. We need to grow the economy. The financial sector is still strong. If somebody tells you there are cracks in it, it's not true. It is still strong, and we need to build it better. So please, next time you hear that a company has listed on the stock exchange and is asking for fund, please go out there and buy your shares. But before that, do your own investigation or call an expert. Thank you for watching Time with Your Banker and Financial Advisor. Bye for now.